Hello and welcome to the Global View on this Monday. Well, the risks of the Federal Reserve slowing the economy more than necessary have become more balanced, with those of not moving interest rates high enough to control inflation, says Fed Chair Jerome Powell. He also noted that the full effects of the Fed's 5.25 percentage points of rate hikes have likely not yet been felt, saying, "My colleagues and I anticipate that growth in spending and output will slow over the next year as the effects of the pandemic and the reopening fade and as restrictive monetary policy weighs on aggregate demand." The Fed chair reiterated that policymaking will rely on the economic data, the latest of which shows that US manufacturing remains subdued. November's manufacturing PMI was unchanged at 46.7, the 13th consecutive month it's been below 50, which indicates contraction. Well, US Treasury yields plunged on Friday as the market perceived the Fed chief's comments as an indication that its monetary tightening is at an end. The 10-year Treasury yield falling more than 13 basis points to 4.21%, while the 2-year was down 16 basis points to 4.55, its lowest since June. The market now pricing in a 66% chance of a rate cut in March. The US dollar fell after 2 days of gains, the Aussie dollar trading at 66.7 US cents. Well, European shares extended their gains from November on Friday, propelled by a sharp rise in miners and as Eurozone bond yields continue to fall on expectations of interest rate cuts. Goldman Sachs, in fact, expecting the ECB to deliver its first rate cut in the second quarter of 2024 compared to earlier forecasts there of the third quarter of next year. Let's get across what is going on in Europe. Anthony Doyle joining us from Firetrail. Great to see you.
Morning, Andrew.
Yeah, so interested just to get that, I guess, that comparison of what we're seeing in the States at the moment. The markets, I mean, they're certain that the Fed is done. What's your outlook? What reading are you getting out of Europe at the moment, particularly the ECB and whether it's done?
Yeah, the big news last week was inflation coming into the low side of expectations of what the market had been expecting. So expecting a 2.7% year-on-year print, and it came in at 2.4%. And that's the lowest year-on-year reading since July 21. Core inflation, there was further good news there with core inflation, the disinflation evident there with a 3.6% year-on-year inflation rate. So the market now is very much of the view that the hurdle for a further ECB rate hike is quite high. And subsequently, they're probably done. They're probably at that neutral to restrictive type of setting, and we may indeed see interest rate cuts from the ECB. And you've seen the sell side start to move forward their expectations for that.
Where are we seeing those prices slow down mostly? Which sectors? And because, I mean, that clearly there, we know manufacturing has been in slowdown. What's going on the services side?
Absolutely. So manufacturing, they're now starting to consolidate and start to understand and start to price in that higher energy price complex. So we may indeed see manufacturing activity pick up in the next 12 months, but the slowdown has really been led both on goods, both on services, and in particular travel has been a particular point of slowdown for the European CPI print. Now, this could potentially be a lead indicator for what other economies might experience going forward, like the UK, like the US, indeed Australia, particularly given that the ECB traditionally has run interest rates much lower than the other advanced economies, and that their 4% ECB rate isn't too far off Australia's current monetary policy setting. So they may be 6 months advanced in the business cycle, but it certainly looks like those interest rates are starting to bite the consumer.
So how's that frame your outlook as far as growth in Europe is concerned? As mentioned there, obviously we've seen that weakness in the manufacturing sector. You only have to look at Germany, which is really the weak spot at the moment, isn't it?
Yeah, so on the consumer side, both in the US and Europe, where you do have inflation meaningfully declining, that will boost real incomes over the next 12 months. So that should support the consumer, particularly whilst unemployment rates remain low and you're still getting those wage increases coming through. So the consumer's in relatively robust health in Europe. Much like the rest of the world, there was a large build-up in pandemic savings accounts of households. And European households still have healthy balance sheets. The one exception and the one concern for the bond market is Italy, where they've largely eaten through those excess savings that they'd built up. So the consumer's in relatively robust health, given household balance sheets. And on the manufacturing side, as I mentioned earlier, we're now starting to see a resumption of manufacturing activity. Now, in terms of the outlook, the upside risk, similar to Australia, is if you see the Chinese authorities come in with a large stimulus package. Typically, European manufacturers are more exposed than, say, the US to that Chinese business cycle, and that stimulatory effect would largely have a boost to European economic growth prospects as well.
What are we seeing in terms of the tight credit at the moment? Is that likely to ease as far as the bank's outlook and their credit standards?
Yeah, so interestingly, bank lending surveys suggest an easing of credit standards, and credit standards have typically had a good relationship with economic growth, and so they were previously quite tight. Banks have started to ease up on those lending standards, and as we know, credit is the lifeblood of any economy. So as you start to see more loans printed, cash flowing into the economy again, you may see a cyclical uplift in economic growth as well.
Is it also worth considering geopolitical risks at the moment, or has that sort of been fully priced, if you like, in obviously the ongoing conflict between Russia and Ukraine? And what sort of risk is that posing going forward, do you think?
Yeah, so I mean, looking at the European market in particular, its valuation is a lot more compelling than, say, the US as a whole. But that's the danger of reading into valuations at those index type of levels, because as we know, the US is more of a tech-dominated index than, say, the European, which is more cyclical and more of a value-driven market. Now, geopolitical tensions and risks, they are so hard to price. But they do certainly come into the equation of valuations when you're looking at a number of companies, particularly with exposure to, say, Russia or exposure to higher energy prices. And indeed, on the value side, if you do start to see energy prices pick up again, that bodes well for a number of European oil and gas producers in particular.
Do you think that's likely? What's your outlook on energy prices, given where oil prices fallen to? Well, this is still about $78 a barrel now. Clearly the market was disappointed with what they heard about OPEC Plus, extending those cuts, but perhaps not as deep as anticipated.
Yeah, so from a fundamental perspective, there just has been a lack of investment in the energy price complex, and we're now starting to see increasing pressure around renewable energy as well. So wind stocks in particular have derated to the tune of 40 or 50% this year. I'm talking about Ørsted, for example. As cost of living pressures have begun to bite, we've seen governments less willing to subsidise those companies, and the difficulty is costs are rising on them with labour costs, but also raw material costs, and the difficulty in integrating this form of energy into existing grid networks without a significant amount of infrastructure spend. So wind stocks have derated to the tune of 40 to 50%. We expect as a house, Firetrail, that energy prices will remain high. Now, forecasting the movements of the dollar is really, really difficult. It's not something that we do, but certainly over the medium term, we expect energy prices to remain relatively high rather than falling materially.
All right, Anthony, let's get into some opportunities you're seeing right now, stocks specifically at least. The first one being Air Liquide, which is, it's a sort of gases and industrial supply technologies for industry and also the health sector.
Yeah, so we really like Air Liquide. It's on a below market multiple for double-digit earnings growth, and it's that rare combination of a quality value style name. So they've really benefited from a decarbonisation push. We know that companies want to reduce the carbon intensity of their emissions. We know that governments are encouraging via regulatory change to encourage companies to reduce their carbon intensity. And Air Liquide is really the industrial gas #1 player in this space. So they will take on the assets of hard to abate industries, implement their market-leading technologies in industrial gases, and reduce the carbon intensity. So on a Scope 4 basis, Air Liquide is probably responsible for the largest amount of avoided emissions of listed companies anywhere in the world. And what's great about Air Liquide is they have revenues that are global. So any weakness in the euro, they will benefit from that.
All right, another firm, particularly in terms of energy management, is Schneider Electric, another French firm, in fact. Why are you looking at this one?
Yeah, Schneider are experts in everything from the electricity grid in, and we know that because of high energy prices, there's an increasing impetus both from households and businesses to reduce their energy costs. And so Schneider are very efficient at implementing their componentry into the smart automation of buildings. So for example, sensors, plugs, switches, in order to reduce the energy costs that households and commercial property owners face. Now, what is also benefiting Schneider at this point in time is they are experts in the higher voltage componentry that data centers require. And they've seen an uplift in orders as a result of the higher processing power that generative AI requires. So Schneider are a beneficiary, a second order beneficiary of this race of investing in artificial intelligence and generative artificial intelligence at this point in the market cycle as well.
Now, in fact, Anthony, we just had that COP28 conference in Dubai, and nuclear energy was certainly a key topic of discussion. Is that something you're interested in at all? Particularly, I guess, we've seen the price of uranium on speculation, perhaps, that more and more countries are now going to turn back to nuclear energy.
So the Firetrail S3 Global Opportunities Fund, we scour the globe everywhere for opportunity, and indeed we have seen a number of, and done the deep dive research on a number of companies that are specialists in renewable and nuclear energy. We are seeing that these opportunities are screening as cheap on our screens that we run on the global investment universe. We haven't taken the step to actually invest in one yet, and it's something that we're paying close attention to. Fortin, for example, is a name that we've been doing the deep dive research on, and we continue to wait to see if it will meet our valuation metrics.
Anthony, as always, great to get a view of your strategy there at Firetrail. Thanks for joining us.
Cheers, Andrew.
All right, that is the global view. Just before we go, a check of the market where we're expected to open in just a couple of minutes' time. As you can see, SPI futures up a healthy 0.9%. Stay with us. The open is just a minute or two away.